Hi, everyone. This is Colin Day with Correct Capital Wealth Management. I'm a financial advisor, and today I wanted to revisit a market volatility webinar that we conducted actually back in May of 2021. Currently, it is January 2022. The markets are experiencing quite an upheaval over the past few months, and so I thought it might be time to maybe record a separate session to maybe gather some thoughts in regards to how we as a firm handle market volatility and maybe how you can glean some ideas in regards to handle your own situations based on what your risk tolerances, time horizon, other considerations as we go through uneven markets. So in this particular presentation, we're going to try to make market volatility our frenemy. And so what we mean by that is our friend slash enemy, because we know that, to have opportunities in the market, we have to have volatility. Volatility, that word itself gets a bad rap because it's normally associated with the negative, but many times it's actually a positive thing for us. So we're going to explore some ideas in this presentation. So for the conversation today, we're going to discuss what is market volatility. We'll talk about some of the recent market upheaval. We'll actually go back to a couple of years actually to discuss some topics. Then we're going to talk about ways to solve for volatility in your own personal investment accounts. So what is market volatility anyway? So, if we want to use a Webster's definition, we're looking at, market volatility can be described as a dispersion around the mean or the average return of a security. So what we mean is that it's the highs and the lows and all of these things considered, knowing that over time, a particular security might perform to a certain percentage return. So we think that the return of the particular investment is going to be here. The market volatility is when it has really high highs or really low lows compared to what the average performance is over longer terms. So when we think of the more aggressive investments, so we think of more of our stock-related investments or more speculative securities in our portfolio, they will naturally have greater volatility. Because that's what they're designed to do. They're designed to grow. And when that happens, they're going to have greater volatility. And thus, you're going to see higher highs and lower lows. Whereas when we're dealing with a more conservative security, which may have lower expected returns, they would also naturally have lower volatility. So the VIX is a volatility index. And this is just for visual ways to kind of describe what I'm verbally talking to you about, is that, the VIX is basically trying to figure out the volatility on the S&P 500. And we're going to talk about the S&P 500 a few times. So just to define that as well, the Standard & Poor 500 is an indice that tracks the about 500 largest publicly traded companies domiciled in the US. And so the VIX is measuring volatility by the number of option contracts being written on particular securities. So what you can see there on the right side in red is, the worst of the pandemic volatility happening in March of 2020. We can see that's when the VIX really hit its peak. And if you go all the way to the right, you can see where we're at right now, which you can see is, relative to March of 2020, nowhere near quite as volatile, but we are seeing some volatility here in January of 2022. Now, over the last 40 years, again, if we're thinking about the S&P 500 largest publicly traded companies, what this particular resource from First Trust is really good because it talks about, what do we see at the end of the year, knowing that there are periods where the market might draw down. It's a very popular term, drawing down, so seeing a pullback from the market. So what this is showing us is, so it's going all the way back from 1980 all the way through the year 2021. So we've got a good 41-year record here. And what it's describing is the blue number is where the S&P 500 ended up for the year. So what was the annual return on this index? And the orange below it is talking about what was the worst decline of that year. So in a very dramatic example, if we look at 2008, right here, if you can see my cursor, we can see that at its worst, the S&P 500 saw a drawdown of almost half of its value. By the end of the year, so again, January to December 31st, we're looking at about a negative 38% return. So if you drew your money out of the S&P 500 index fund you're invested in, you likely would have lost somewhere around half of your money at the worst part of the market. But if you'd held on, again, from January to December of 2008, you would only experience a 38% loss. Doesn't really seem like I'm putting icing on the cake there, but the reality is that, most of the time when you look at over the longer term here, this 40 years, there's only a handful of years that saw overall negative returns in the S&P 500. So again, thinking about like that very next year in 2009, Again, at its worst, there was a drawdown of 28%, but by the end of the year, the S&P 500 was up 23%. Or to use another dramatic example, if we look at 2020 over on the right, we can see at its worst, the S&P 500 drew down about a third of its value, 34%. By the end of the year, the index was up 16. So this is just to show you that these types of declines happen not within a vacuum. They happen all the time. It's very common to see years, where there's multiple double-digit declines. But when we look at the long-term picture, we can see that the market does perform well as long as we're consistent in the approach and we have the time horizon to withstand that risk. So other popular terms that we might address throughout this presentation real quick, we've got recession. So recession is a drop in the gross domestic product for at least 2 quarters. Depression is going to be a drop in GDP that generally lasts more than 1 year. Market correction is a 10% loss from a recent high. So where we are right now at the end of January 2022, that's kind of the next metric that we are approaching. Depending on what index you're looking at, we might already be at a 10% decline from a recent high. Bull and bear markets are when we have a 20% gain or decline. So if we continue on this path where we see the market pulling back and things selling off, we might go from around a 10% overall loss in the, let's say the S&P 500, and we'll go all the way down to 20%. And then at that moment, we would be in what's called a bear market. So bulls and bears, we like bulls. We don't necessarily want to always see bears. But what we don't want to always see bears, I think this particular slide tells the best story for those of you that are watching this and are focused on retirement-based investing. Because this particular slide is going over almost an 80-year period, discussing how the markets have performed over time in bull and bear cycles. So on this slide, you can see blue is a bull market. Again, that's the good market. Bear is in that yellowish orange, and that's the bad market. In gray, highlighting in certain areas, you'll notice recessions. So again, First Trust creates this particular report, and they update it periodically throughout the year, generally every quarter, and they kind of extend out what's happening most recently to talk about both, again, the positives and the negatives. So if we look all the way on the right, we can kind of see the end of a bull run, right when the pandemic hit back in February and March of last year, or excuse me, in 2020. So we can see that there was just that itty bitty blip, that really small blip of yellow right there, that 1.1 month, where again, we lost somewhere around a third of the value in the S&P 500, and we had a very dramatic short burst of a recessionary period to coincide with the bear market. But then for the last 1.8 years, ending in December 31st of 2021, we could see that growth coming back from it. So all this is to say is that if we look over this particular chart, probably the thing that you saw before I even started speaking about it was that this chart has a lot more blue than it does that yellowish orange. That is to say that bull markets outperform the bear markets. But we as humans, we tend to react more negatively to bear markets than we do more positive bull markets, right? When we turn on the evening news, we don't expect to hear every single story is sunshine and rainbows. They generally lead with all the bad stuff. And that's because it gets you riled up and makes you want to listen more, because there's got to be something good by the end of that broadcast, right? But also they know that, we are expecting to hear negative news. And that's what happens when you watch your favorite business-related TV programs, because they are going to lead with what's going bad, because that's generally what catches viewers' eyeballs as opposed to the positives. And so we think about this chart over long periods of time. And again, when we think about retirement-based investing, not speculative or short-term things, if we have time on our side, we're going to look at this to say, hey, we have opportunities. The market performs well. That bull run from 2009 to 2000, basically to 2020 to the beginning of it, lasted about 11 years. And, that was cumulative 400% return for investors, in this case, in the S&P 500. So it's very important that if we have the time horizon, if we can understand that, we as humans behaviorally react more towards the negative than the positive, starting to hold your funds when we go through these volatile time periods becomes a little bit easier to understand. So, recent market volatility and what we can learn from it. So we're going back a little bit with a couple of these topics. I didn't want to reset everything that we discussed in a previous webinar, but I think these three things, we think about what happened with COVID originally in 2020. We'll talk about a little bit about GameStop. Yes, GameStop is still a thing if you haven't heard of it recently, and Bitcoin, and just kind of thinking about where things have gone over the past couple of years. So here in 2020, this slide is from Yahoo Finance. So basically, this is just, how did the S&P 500 index perform from January 1st, 2020 to the end of the year 2020. So we can kind of see where we started off on January 1st. The index was at 3,245. And then we could see that about February 19th, we reached a recent peak. And then coronavirus shutdown started to happen. Infections started to rise. Deaths, unfortunately, started to increase. And by March 23rd, we had dropped quite a lot. Then by June 30th, we had almost leveled off to where we were previously. And throughout the year, we actually saw, like I mentioned before, about a 16% growth from January 1st to December 31st. So this kind of incredibly dramatic market volatility kind of showed the power, not only of just markets and money, but how we react as investors. Because, well, as an advisor, we fielded quite a few phone calls in early 2020 to determine, what's the strategy? Should we be making moves? Was it appropriate to be in the level of risk that we were in? And does the pandemic change things for us? So for most folks, it meant holding as long as it was a retirement-based strategy. But for those people that were considering retirement in the near future, it may have resulted in some different ideas in regards to investing. It may have even changed their perspective on retirement, because maybe now that they wanted to retire earlier, knowing what's going on out there. Or maybe they decided, well, I have to hold on a little bit longer because I bailed on the market at the wrong time when the market was dropping. And so now we have to kind of hit the reset button and figure out what's going to be more appropriate for us. GameStop. So GameStop, if you recall, this is the video game store, became kind of a what they call meme stock, where individuals were pushing for this, the valuation of this company to rise. It had to do with hedge funds, had to do with options trading, all these other things that we won't get into. But we can kind of see the dramatic rise by the end of January, and that almost 1,800% growth on it. Its precipitous fall and then immediately incline to where we settled today, or yesterday on the 24th at about $100 a share. So still, if you got in at the right time, you might still be up in GameStop for all I know. But the reason, that we think about volatility in both the positive and the negative is that volatility can mean, good. So, volatility could be a good thing. You just have the upside and you're not experiencing the downside. So I want to make sure that when we think about our portfolio allocation, thinking about GameStop for a moment, is that, we don't put all our eggs in one basket. Yeah, it would be really cool if we got out on January 27th after investing in it, months earlier. But the reality is that not many investors have that kind of outlook or that kind of speculative strategy in their back pocket. So for most folks, it's, yeah, we're going to experience volatility, but we know how to diversify our accounts to make sure that we're participating on the good side, but maybe not always participating fully on the downside by devoting 100% of our funds to it. And then finally, Bitcoin. So this is a little bit of a more dramatic chart here. This is going back all the way to, I think, into 2018. So we can kind of see back on February 6th, after some recent inclines, the price of Bitcoin had dropped to about $3,400. But by April 19th of 2021, with the pandemic picking up and decentralized currency becoming the topic du jour and something of interest, and because there was money out there, because people weren't going out and doing things, Bitcoin becoming suddenly more popular, people studying up on it, understanding it, and wanting to become a part of it, saw a meteoric rise. So from February 6, 2019 to April 19th, 2021, in that about, almost 2 years or so, it climbs another 1,600%, just over that time period right there. But then a few months later, we see it falling again. And now, after that, we can see it increasing again towards the beginning of 2022 and falling again. So we're in the situation again, and this is more of a topic of diversification, but ultimately, when we think about where we position funds, where we see things, volatility can be a really great thing. It can mean that you're on the momentum side and knowing that you're building up wealth in a particular security, but it can also mean that there's the downside as well. So it's all about understanding your risk tolerance and your time horizon to make decisions as to how we position your wealth. So for those of you that are confused about market volatility or very uncertain as to what's going on in the market right now, whether you're viewing this in January 2022 or sometime in the future, there's always ways to help solve for market volatility. It's not the solution for market volatility, but it can help you maybe conceptually understand why we position assets the way we do. And one of the things that I talk about with our clients a lot is being intentional with their buckets of money. And what I mean by that is, there's a reason that we have money in cash. There's money in the market. There's money in bonds. There's money in annuities. There's money in your pension plan. All these different buckets of money that we hold on to assets into are all designed for a particular reason. And as long as there is intention as to why we're positioning things the way that they are, so that it can last throughout your retirement, that's great. That's exactly what we want this to be for us. What we don't want this to be is, I'm filling up a whole bunch of buckets and I don't know what exactly all of them are doing. That's where conversations with a financial professional will likely help. So here's the first thing that we want to think when we think about market volatility and how we try to help solve for it. So know when to hold them. Right now, considering where the market's been over the past few months, if you're a retirement-based investor, you probably know that retirement investing is a long-term strategy. And even if you're a couple of years away from retirement, you might be thinking, I'm going to retire this time next year, for example. Well, it's not just the next year that we're planning for, of course. We're planning from your retirement date all the way through your retirement. And so if you're the traditional age 65, we might be planning for 25, 30, 35-year retirements. And if that's the case, we definitely need to know when to hold onto assets and when to maybe reconfigure things, because we're not just, again, talking about the next year while you're still in the accumulation phase. Now we're in the spending phase, and that still matters where we position things. So we want to make sure that we still have that purview when we think about how we withdraw things. Timing the market is one of the hardest things to do. Especially when we think about the types of securities that exist in this retirement space, when we think about like ETFs or we think of mutual funds, because they're very broad instruments. They're investing a lot of different things. Many of them are focused on indexes. So it really isn't a day trading type of account. And because of that fact, market timing doesn't generally work with those instruments because you have no control over how the fund manager is controlling the investments. You have to rely on their experience as to whether or not they're doing the appropriate thing. And of course, you're not just buying one particular company's stock, you're probably buying hundreds or thousands of companies underneath that one mutual fund wrapper. So we have to be cognizant of the kinds of investments that we're investing in, but then also knowing where to hold them and when we need to move in and out of different things. And of course, moving in and out of your investments can affect your ability to meet your retirement goals. That was pretty self-explanatory, I'm sure, but it is that idea that, if we're going to be moving in and out, we might be moving in and out at the wrong time. And, when we think about over time and we think about these market cycles that we go through, we can probably pick out on this chart where we are currently. So if we think about this chart, so we've got time on our x-axis, performance on our y-axis. When things are going up, we feel really good. Everybody's winning, everybody's making money. That's wonderful. But when things start to head the other direction, not knowing how long it's going to take us to hit that next bottom, that's when we start to see some people moving out at inappropriate times. So we can kind of see like this mentality of, it's only down a little bit. It offers a buying opportunity. Maybe I'll put a little bit more money in the market. And then things continue to drop and they don't work out exactly how you think. And you're like, what is going on here? I don't understand. I thought we were at the low. I thought I was already there buying, and now we're still going lower than that. And then we unfortunately see many people making rash decisions to bail on the market at completely the wrong time. And then when things start to rebound again, not knowing exactly when to come back into the market. And it would not be one of my presentations without at least one Michael Scott quote, no question about it. I'm ready to get hurt again as soon as the market's already rebounded and we've missed out on that opportunity to enjoy that rebound because we moved out possibly at the wrong time. So it's very important to know when you are in the kind of portfolio that you should be in, and then when it's appropriate to maybe take a step back and reevaluate. So diversify. So this is the second idea for solving for market volatility. On the spectrum, we've got inflation risk and we've got investment risk on the other. But really, when you think about your retirement-based investments, so whether it's in your 401k or your IRA accounts, whatever it might look like, we always have different instruments to invest in. Some are going to be very conservative, some are going to be very aggressive. Those conservative instruments, as illustrated on the screen, are more of the short-term investments in bonds because they are providing maybe a nominal return or an opportunity for a nominal return. And that's the degree of safety that you're looking for to make sure that you're maybe keeping up with inflation over time. Now, of course, there is that inflation risk, and that's what that means by that spectrum, to say that, if we put ourselves in too conservative of an instrument and inflation picks up like it has over the past 12 months, now we're in a situation where we're losing purchasing power. So if I'm making 0% in a money market right now, and annualized inflation is around 6%, I'm at a -6. I'm at -6%. So whatever I've got in that account, I'm practically losing money over here. So that means the other portion of my portfolio, which might be your stock portfolio, where you're taking investment risk, now we have to do double duty over here because we're not making anything over here. We're earning 0% because we put it all into a money market. So now my investments in stock have to do more. But of course, there's investment risk like we're experiencing right now. The market's not always guaranteed to go up. It will have volatile periods of time. And so it's this balancing act between the two sides to understand where we should position things. And then again, holding a steady hand to the market to know that, again, not everything is sunshine and rainbows. We will run into situations where things aren't performing well, but we have a strategy in place to diversify across all these different segments. And when it comes to diversification, the more diversified or the more broad it is, generally speaking, the better it is from a volatility perspective. And as a slide from JP Morgan is describing, is you've got a less diversified portfolio on the left and a more diversified one on the right. And both of them are keeping the same kind of components. They're not trying to change the amount of risk in the portfolio, but what they're doing is they're taking 3 securities on the left and diversifying it more fully into, I think that's maybe somewhere around 8 investments on the right. And so by exploring within the space of US stock or the international stock market or different kinds of bonds and credit instruments, those are that generally can lead to better results over longer periods of time because it's trying to smooth out the risk. You won't have the highest highs, you won't have the lowest lows. So within that risk tolerance, it's trying to figure out, okay, what is the best way to experience growth without also experiencing all the downside. So finally, dollar cost averaging. So if you participate in a 401k plan, this is going to sound very familiar, even if you've never heard of this term before. So DCA is a strategy where one regularly contributes to an investment account and you purchase securities at the price they're offered on that day. So if you're nervous about the market and you're sitting on cash and you're not sure when to put it into the market, using dollar cost averaging might help put that money to work at increments, not knowing when the market is going to reach a new low or whether it's the best time to put in. So if you're already participating in something like a 401k plan or 403b or 457 plan through work, you're making regular contributions into your retirement account over every 2 weeks or so or every month. And by doing so, you're already dollar cost averaging. And I think maybe this example that we're going to go through is going to help. So we have Megan and we have Jason. So Megan and Jason both are sitting on $6,000 in cash. Let's say they got their tax refund and they are looking to put that money to work. They've got enough money set aside in their emergency fund. They feel that they are prepared to get investing with it. Now, they both identified the exact same security, in this case, ABC company stock, just a pretend company. Their contribution strategy is going to be different, though. Megan's going to try dollar cost averaging. So she's going to periodically put money in. She's going to put it actually on the first of every month for 6 months. So she's going to do $1,000 a month for 6 months. Jason, on the other hand, just says, let's just get it all to work. Let's put $6,000 into the account immediately. So in this example, this is hypothetical, let's say that the share price of the security doesn't stay flat. It doesn't go immediately up, doesn't go immediately down. It has a little bit of ebb and flow to it. So Jason, again, on January 1st is going to make his deposit and he's buying the security at $27 a share. And that's it. He put $6,000 to work. We divide that by $27 and he's going to get X number of shares, which we'll discuss in the next page. So Megan, though, again, is using the dollar cost averaging technique. So she's putting in $1,000 on the first of every single month until she's through with her 6,000. So we could see, like Jason, she buys $1,000 worth of shares at 27 bucks. So disregarding any kind of commissions or trading costs, she's going to get a certain number of shares. The next month, the share price went up. So her $1,000 goes in and she now purchased more shares, but now it's at $32. So as you could probably guess, because she's buying at a higher price, she doesn't get as many shares. So, shucks for Megan, she didn't purchase at the right time. She doesn't get to purchase enough shares here. But as time goes on, it just so happens that the stock, that 32 bucks in February was actually the high. And then it starts to drop and drops pretty precipitously. Maybe they had a very bad earnings result or maybe some kind of scandal within the firm. In May, it ends up dropping all the way to 17 bucks. So when Megan puts in her $1,000, she's buying more shares now because it's much lower in price. And then we can see in June, it picks up, and then July it picks up even more. She stops purchasing in June. That's her 6th deposit. But by the time this time period is over, we can see that the share price has increased. So if we get to behind some of the math here, both Megan and Jason have put $6,000 to work in the investments. Now, the average share price, though, that they purchase at is different. Again, Jason purchased all at once, and so he got it at $27 a share, whereas Megan was purchasing at an average share price of $25.33. This one, it comes out in the wash. Jason got 222 shares, but Megan got 248 shares. So she is actually 26 shares richer, not including all the ebbs and flows in the market as to what the share prices are and those gains. And so she has more shares than Jason to sell to do something else with, or to enjoy greater growth in the future. So this is just a hypothetical example of how dollar cost averaging works. And again, if you're already participating in your workplace retirement plan and you contribute on a regular basis, you're already doing this. And we just want to make sure that over time, we're purchasing at that average price, which is slightly lower than buying it all at once. So here's our last thought. So tough times don't last, tough people do. So going back to that original chart that I showed you at the beginning of the presentation from First Trust, when we think about bulls and bear markets, we saw a lot more blue than we saw that kind of yellow-orange. And if we think about the average length of return over bull and bear markets, we can see that bull markets last longer, 4.4 years compared to 11.3 months, so less than 1 year. And the average return is greater in a bull market than in a bear market. So again, if you take something away from this, is that if you're a retirement-focused investor and we're thinking about long periods of time for investing, for as long as you're within your risk tolerance and you have that temperament to be able to withstand market fluctuations, the media, and your friends and everyone's talking to you about how badly things are going in their investments, and you hold that steady hand to the market, for most individuals, it's going to be a better option than suddenly making changes. So each of your situations is a little bit different, however. So if you do have questions in regards to how to handle market volatility, or am I allocated correctly, or you just have some general questions, feel free to give me a call or send me an email. I'll be happy to answer whatever I can for you. So I appreciate your time today, and I wish you well.